Hi, everybody. I'm Constance Freedman. Thank you so much for coming back to another Modern Ventures speaker series. I am so excited to introduce Matt Ehrlichman as this week's or this month's guest. Now, the reason we invited Matt is because of the SPAC craze that's going on today, all things SPAC. Now, Matt, who's the CEO of Porch, was one of the first companies to go public via SPAC. I mean, not one of the first, but one of the first ahead of this craze. And we were proud beneficiaries of being investors of having one of the first companies in the new craze to actually go public. And there's so many great things that came out of this and so many good things. And, you know, as people start questioning the validity because of the craze now and who should SPAC and who should not, it seemed like a really good opportunity or a really good time to interview Matt about why he did it, his journey, advice to both startups who are thinking about it, as well as investors who are targeting new companies, and really kind of give the real on the SPAC thing. So with that, I'm going to introduce Matt. I'm going to mostly let him introduce himself, but he's had a wild ride as a entrepreneur. I guess I shouldn't say wild ride. He's had an amazing ride. And he, successfully has started more than one company. So I want him to tell you a little bit about that, a little bit about Porch and what it does. And then we'll kind of jump into all things SPAC. So with that, Matt.
I'm excited about that conversation. It's great to be here with you, Constance. I will say, just for the audience out there, since they'll be connected certainly to Modern. The Modern was a great partner, as was Constance, as we built up Porch into where we are now, which is a public company. Porch Group, which trades on the Nasdaq, PRCH. It has been an amazing journey. I've been very fortunate to have built a few companies now that have been successful companies. I started my first software as a services company back just out of Stanford. I sold that company after bootstrapping it for a number of years very successfully. I was one of the executives at the acquirer that we took public after 4 years. And then I transitioned out to go build one more company, which is Porch. Porch was born with a pretty simple idea, which is to make the home simple. So to take this space that so many of us think about, the home, one of people's biggest assets in their lives, and yet, it is so painful. If you look at the whole life cycle that people have with their home, we have taken a very unique approach in our strategy to solving that problem. Porch is a vertical software platform where we provide ERP and CRM software to home services companies, like home inspection companies, moving companies, roofing companies, and others, where we embed ourselves really deeply in these businesses to help those companies to grow. Those companies pay us with typical SaaS fees, but they also pay us in a unique way where they pay us with transactions, in effect, by providing us introductions and access to their consumers, who we then help with really high value services for that new home. So we really layered in key things like insurance or moving or TV and internet setup for that next home that consumer is going to be moving into. It's a similar flywheel to like an open table, where they provide software to restaurants, get access to the consumer, monetize with transactions, and drive demand back to those companies. We built large scale. So Porch right now has 28% of all of the home inspections that happen in the country are managed through our software platform. And we meet a huge portion of US home buyers every month from these companies without having to go do direct to consumer advertising. We're just introduced to these consumers very early. And again, we've really focused on a service like insurance, where we've gone from an insurance agency to we've gone deeper in the value chain, where we now are a managing general agent and carrier, so we can directly help those consumers with insurance, for their home. Last couple of things, just to give you a sense for where Porch is. We're around 1,000 people, full-time people, headquartered here in Seattle. We've guided revenue now as a public company in 2021 to 175 million in revenue. And so we've actually increased our guide we'll talk more about this, I'm sure, but we started off with a $120 million revenue guide here for 2021, and we've been able to increase that now to $175 million. That's what we anticipate for this year. Very high margin, revenue company. So mid to high 20%, cost of revenues. And then separately, that insurance part of our business is really scaled. So we expect around $270 million of gross written premium, here in this year. We really focus on homeowners insurance as the lead, and then bundle other insurance in. I can talk about it all day long, Constance, but I know you've got a lot of questions on SPAC. So I'll pass the baton back to you, and we can dive in.
Yeah, thank you. Okay, so as a venture investor, and as an entrepreneur, our goals are aligned, and that is ultimately an exit, right? And so traditionally, we've always thought about exits as being IPOs, M&A. PE over the last few years has become more of an exit. And, wow, this SPAC thing came up, and, it typically wasn't very common. And, when Tom Hennessy had reached out and said, yeah, I'm starting this thing called PTAC, Property Tech Acquisition Corp. And do you have any targets? It was like, that's an interesting exit opportunity. and of course, you guys were the perfect fit, but you had to give that a lot of thought. I mean, we had, collectively as a board been talking about IPO as the most likely exit for Porch. And this sort of fast tracked it, and that had pros and cons. But maybe you can talk a little bit, I guess, first about, your decision on why you ultimately made the case to the board that this was the right thing to do versus wait for the traditional IPO.
Yeah, I mean, you're right. I didn't even know that much about SPACs, candidly, 18 months ago or whatever it was before we, even had the first conversation. I intended either probably to, take the company public, and that was the hope, through traditional IPO like the previous company, or if not, see if at some point along the way we sold the business. But, I've always entered this business with the idea of wanting to build something, truly great, wanting to build something that's enduring. And I believe the best way to do that is to be able to get the company, public, where you have just additional capital and resources that are available to be able to do that. The reason that we chose to do a SPAC when we started that conversation was really about time. To your point, we thought, getting public through a traditional IPO, we would have been looking at probably late 2021, but we were able to pick up an entire year, and be able to get the company public, late 2020. But here's the key thing, I think, for listeners, which is it's not just about getting public sooner, because there, again, like you said, there are pros and cons about SPACs, and we can talk through that. But you do dilute some incremental additional amount in terms of some of the company that goes to the SPAC sponsors. And so there has to be a reason where you can create value, by getting public a year earlier, which in turn has the math all make sense, right? That's the right thing to do for your shareholders. For us, we were in a situation, Porch was, where we had a certain set of acquisition candidates that if we could go get public sooner, that we could go pursue those acquisitions. And those are really nice, strategic fits for our company that we could be able to layer in, not only grow faster, but be even just that much better position to build what we're trying to build long term. And so that, I would say, that particular point really is the catalyst, to us wanting to go and pursue the SPAC path.
So what advice, we have so many of our portfolio companies saying maybe, SPAC stars in their eyes now, right? And honestly, like, I've got it's Wednesday, and I've had 4 calls this week, inbound on, sponsors looking for targets. And, what advice, let's start with the entrepreneurs, the CEOs. What advice do you have for them? Actually, I'm going to ask you, what advice do you have for them in terms of like, should you or should you not? But maybe before we get there, why don't we continue on your journey? So this is the reason why you did it. And then let's talk about the process. Like what didn't you know? And, like what what was the process like from kind of, you made the decision, let's do it, to actually IPO? And by the way, we rang the bell, so to speak, on Christmas Eve, 2020. Yep. So when did that start? And then the decision, and then talk about the process of getting of all the way to actually the IPO.
So the key thing people need to know is that a SPAC is just another way to go public, and it really is a lot like an IPO, having gone through both of those two things. Ahead of the process of going public, you need to be able to find that SPAC partner. You need to negotiate through the terms. So it's not a situation where you're waiting until the very end to see kind of how the company's going to be priced. You do that work up front, and you can negotiate through that with one partner. And the SPAC gives you the ability to have other levers to pull to kind of work through that negotiation, like an earnout or things like this that you can kind of bring into play to bridge any valuation gaps. But you need to deal with that up front. You get the purchase agreement done. But at that point, it really is a lot like like just a typical IPO, where you go and you do a roadshow. For me, that was all virtual, where you sit and you go through the PIPE roadshow process, where we probably had 50 investor meetings in a 7 or 8 day period of time, just back to back to back. We had gone out targeting to raise a $50 million PIPE. This would be something I'd suggest, is just set low expectations up front, because when we had $300 million in orders and upsize it to $150 million PIPE, you just start to build momentum right in the company. From there, a key part of the process is what's called a Despac process. So after the PIPE, we then announced the deal and announced the PIPE simultaneously. Typically right now, the current shareholders of a SPAC are typically, hedge funds, ARB funds, before a target is announced. And so, that's who invests in a SPAC when it first goes public independently. And so, one of the things that I spent a lot of time on that was really, I think, important and impactful is to meet, other investors, these large, long-term, fundamental public investors, and meet lots of them, even before the IPO, to be able to tell them about the story. Because what happens is those firms, those investors, start to buy stock in the SPAC even before the transaction is complete and even before the IPO. And so shifting out the arbitrage and the hedge fund shareholders into these long-term shareholders means once you complete the IPO, which yes, we did on Christmas Eve, your stock and your shareholder base is now much closer to where you want it to be, long-term. And that creates, a situation where you don't have lots of selling pressure, right after you're in public. It's people that want to be with you and believe in what you're building. We've been very fortunate. Porch has been, I think, the 8th or so best performing SPAC, stock out of 300 or something like that. And a lot of SPACs trade down from that starting $10 per share price, in part because they haven't done all that work, to get the right shareholder base in place. And in part because, you need to be able to build expectations in through those conversations that you're going to be able to outperform, and be able to make sure that you are set up. It's tempting to build, these projections in, and we built fast projections, but we also knew we were going to be able to outperform, those expectations, and we've done that, really well. And then you just are able to build momentum, in the company where people trust you as a newly public company. So basically, we went through the Despac process. We took the company public. We rang the bell here virtually, and then you're off and going. I mean, then you are a public company. At the end of the day, just like as if you had gone public through a traditional IPO. There's a little more lessons. Maybe I'll give you one more, and I'll turn it back over to you. But one of the things that I learned is that when you're thinking about the partners to work with, the banks to work with, understanding that research and sell-side analyst is important afterwards. That's something I wasn't that thoughtful about. I wasn't out ahead of kind of understanding how important sell-side research would be once we were a public company. And so working with banks that are going to be able to bring research as part of their value proposition to help facilitate that deal is helpful, because that's one of the things that sometimes SPAC IPOs don't have that typical IPOs do, where you go public through a traditional IPO, almost immediately you're going to have research reports that are published. They just create that marketing and that awareness to lots of investors. That would be really helpful, to Porch day one. Now we've had to go just earn that. We have had several, research analysts kind of publish as we've gone. We do want a few more though, as we go forward here, and that's part of what we have to go do.
Because you want people to cover you and you want your stock, the volume of trading to go up over time.
Yep. At the end of the day, look, the reality is there's lots of public companies. And so as a newly public company, you have to be able to make sure your story is being communicated, right? Not to everybody, but to the investors that you want to be shareholders, in the company. And because as the stock price goes up, that gives you more ammunition to be able to do different things, whether that is, raise money if you need to, whether that's to be able to buy companies, whether that's to be able to just recruit team members, into the company. And so, part of that is that sell side research coverage that can be able to talk about your company, go really deep. And that just allows more investors to learn what you're doing and be able to start getting on board.
So for those, and I've had this question come to me a lot. So maybe talk a little bit about for those investors who come in on that pre-IPO place where you said, it's so important to get people involved before you go. What's their incentive?
So it's just they believe they can buy in, earlier into the company before the IPO is complete, and the stock starts to move up. So, lots of times investors are trying to find, moments where they can be able to, invest in companies before there's broad awareness of the company. I believe, that's the case personally for Porch even now, where there's a huge, valuation gap between how we're valued and other vertical software, peers or other vertical software companies that monetize with SaaS fees and transactions. And other investors believe the same, and so they would want to invest, earlier in that game. But in the pipe, that's certainly what those investors are trying to do. So pipe investors for us, invested at $10 per share. And now a few months later, the stock is $17 per share. So already they've made a really nice gain, on that investment in a short period of time. But it's the same thing in that, that Despac process, where some investors are just able to get out in front of the IPO. They take on a little bit of risk that, okay, does this deal not actually end up happening? But they feel like they can offset that by being able to invest at a lower price, and that's why they do it.
And in the case of Porch, they had a lot of success with that. So
yeah,
that's great.
They made great returns, and we feel like we're just getting started. And I think they do as well. We've got, a really good, solid, long-term shareholder base that believes there's a big opportunity here.
So being public now, whole new ball game. It's not the same as our friendly board meetings of the past. if you miss a quarter and as a private company, you get your fair share. You hear about it. But if you miss a quarter as a public company, it's a really different deal. So talk about what it's like being on the other side as a public company.
Yeah, and especially in the first year or two, because you're just building these relationships with these shareholders. They don't really know you yet.
Yeah.
And so it's important that you establish credibility and trust with those shareholders, which is why it's really important to deliver results. And it's just about having set the right expectations and outperforming those expectations so that they know that you're in control of the business and that, that they can trust what you say, as you kind of point to the future. So it is important. I think that is one of the things that I would share, with people, that you don't want to go public through a SPAC. You might think about it as an acquisition. It's not an acquisition. It's going public. And so if your company is not ready to go public, don't go public, right? Because it is a bit of a different game. You have a different pool of shareholders, and you're not going to get, value out of the company. It's not like you are taking the company public and then you go sell stock. I've not sold any of my stock when you're public. It's all about positioning you to be able to go and run and build something big, for a long period of time. And so I think sometimes people might have stars in their eyes around SPAC, where it feels like there's just lots of companies that are, public companies that are buying companies. It is not like that. It's just a mechanism to go public. And so that needs to be really clear that, that if you aren't interested in going public through a traditional IPO, you should not be interested in doing a SPAC, either. Because you'll just get public, and then the stock will end up trading down if you don't overperform, if the company's not ready. And it's just going to be not in anybody's best interest, your current or past, shareholders. I do think right now there are a lot of SPACs, and the way that it works with SPACs, there's more SPACs than I think is the appropriate number. Now there's not enough good SPACs So I think that the mechanism is a lot of validity, and I think that SPACs are here to stay. But I think there's more, SPACs, and there will be in 2 years. I think that the good ones, the franchises, are the ones that'll stick around. But because of that, there's going to be lots of private companies, that have SPACs coming and talking to them about, hey, let's go make this happen, and we can make it happen, because the SPAC has to. They have a shot clock. They have to get that transaction done, in typically an 18-month period of time. If they don't, then they're out of a bunch of money, those people that started the SPAC. And so they are going to be pressing private companies to go perhaps public sooner than the company's really ready, for. And so as investors and others, that partner with these companies, it's important to be just thoughtful about which are the right ones, that are really good candidates. And again, you don't want to do it before it's the right time, for the company.
So you said 2 things that I think are worth talking about. Number one, be ready. And so I don't think there's enough startups that understand what it means to be ready to be public. So we should talk about that briefly. And then the other thing that you said that I think is really important is there's not enough good SPACs. So let's talk about what a good SPAC means. So let's start quickly about what it means to be ready to be public.
Yep. So there's a lot that goes into being ready to be a to be a public company, but at the end of the day, it means that you have a good company. And what I mean there is, it's a big opportunity. You have the core unit economics in the business that you understand and work well, so you're able to control the growth of the company. You've got the team in place, where you have people that are going to be able to operate, especially because the CEO, your time might go from spending a lot of time on product, and a bunch of your time is going to get sucked into, managing and investor, relationships, right? And the analysts, and that's just part of the tax and the reality of being a public company. If you have the team in place that can not miss a beat, that's really important.
I think you're talking about like the stuff that a lot of companies have. I think it's the nitty gritty stuff to me. Like it's like your audits are clear and for public consumption, and your books can be closed in time and ready for public consumption, and your accounting is in a place that you're not going to have to restate how you do that accounting a year from now. So I feel like
let me address that.
Stuff
let me address it, because there's 2 things I think about there, which are, if you are a good company, you can go hire those things. Like if your business is at scale, you're able to grow, that you can go and get this is often what happens. You hire that CFO who has public experience, and they bring new people around. And we had to go through a lot of that, accounting infrastructure building. If you do it through a SPAC, that's a really accelerated process. So it's a very intense, process. But you can go hire that to be able to help the company accelerate getting the accounting in place. To your point, it's the bar, right? So you have to be able to do it, and so you have to, but there are people out there that you can hire, to be able to go help you, with that, process. But, what I really focus on, what's much harder, I think, than that, because you can't hire it, is you have to have a company that's going to grow for a long period of time and be able to grow its top line, grow its margins, something that, is going to be systematically a good company. And I believe entering in the public markets, you want to have, some cards up your sleeve that you can play to be able to drive additional growth and to be able to surprise, and things that you can do to be able to accelerate, growth as you go. And so those are things that I think are really important as you think about kind of, are you ready or not?
I'd put it not surprise, but delight.
Yeah, that's a better word. That's a better word. Surprise to the positive, which is the definition of that is delight. Yes, good.
Okay, so what makes a good SPAC? Like, what's a good partner, for someone to make sure that they're going to get married to in this process?
Yep. So as always, whenever you're entering into a partnership, it has to be, people and that fit you and fit the values and the culture of your company. Just like when you're hiring, it's obviously, again, the bar. Secondly, you want people that have the right kind of experience, and connections. So working with people that have gone through the SPAC process before, obviously is going to increase the likelihood that that is going to go well, just because they have advisors and connections around them, that they're not going through it, for the first time, and it's just going to be able to shortcut, any possible kind of learning moments. When going through that PIPE process, it's important if PIPE investors will just join on, with SPACs that have done it before and they've had success with, before. So not only SPACs that have done it before, but SPACs that have had success in their franchise certainly helps. People that are going to be able to add value, in different ways, is an important part of the process. So I always think about, how you're going to be able to add value, or how people are going to be able to add value. And then lastly, thinking about the right size. It's not a situation where, the bigger the SPAC is, the better. We moved forward with a SPAC, which had raised $172 million. And that for us was the right size. We layered on top $150 million pipe. So we brought in, $320x million, in total. But that was the right size for us, because you want to be thoughtful about how much dilution you as a company are willing to, incur, as part of the ownership that the SPAC sponsors get. So there's a bunch of different factors in there.
So walk through that a little bit. So the 150 SPAC, the 172, the pipe, and then the public offer and dilution. Like, walk through for people what that means.
Sure. So before completing our IPO, when we were a private company, I had 43% of the company. This was my ownership stake, just as an example. You go through that process, and you have, obviously the PIPE investors that are putting $150 million in the company. They get a good chunk of ownership of the go-forward company. You have the investors that had previously invested in the SPAC, so they put $172 million into the SPAC when it first went public. They obviously get a good chunk of the company. And then the SPAC sponsors get a portion of that, in which they raise. So they get a portion of that, in terms of ownership in the go-forward company. When it's all said and done, my 43% ownership goes to the lower 20s, right? Because we chose to raise that much money. But if we had gone with an even bigger SPAC, a $300 million SPAC, $400 million SPAC, $500 million SPAC, well, obviously, that dilution is just going to be even that much more meaningful, there. Now, for us, again, how does the math make sense, to go through that? Yes, I dilute, but all of a sudden we have a lot of capital in the company, which lets us go and be able to, in our case, acquire the right businesses and invest in the right initiatives, so that we can grow, very quickly and just be much more valuable than we were as a private company.
A smaller piece of a bigger pie.
Yep, exactly right. Yeah, at the end of the day. Yeah, as is always the case when you're raising money, right? And that's always the choice. And this is just, it's an opportunity to fundraise while simultaneously entering the public markets.
And talk about the process for how you set the valuation with your SPAC investors, and, advice with other people going through the same thing.
It's a good question. So you try to have it be, as always, it's a negotiation, at the end of the day. I think that actually it'll be in some ways easier for entrepreneurs now, just because, again, there wasn't even that much awareness when I was going through the process of SPACs. And I think now most people, if they're choosing to go that path, they are, creating not an auction, but creating a competitive situation, with SPACs, where you can be able to, have, clear leverage in that negotiation. But what we did is we were just very pragmatic, and negotiate back and forth, looking at what set of public comps, we were most similar to, using those comps and the multiples that those companies are getting, to be able to get a sense for how we would be valued as a company, what was a fair and appropriate, valuation. And so that's what we use to really anchor, some of those early discussions. And then again, like I mentioned, there will always be certain gaps, in that negotiation. And so there's things that we brought in, such as, a larger management incentive pool, or such as an earnout, that we could achieve as we get to $18, $20, and $22 per share. That there's additional equity, that we get, at that particular moment in time. So you're able to bridge the gap with with that negotiation. The one piece of advice, though, that I would have, and I don't think a lot of people are thinking about this, is I wouldn't be focused on just maxing it out, because what you need to do is you need to enter the public markets at the right valuation, such that the PIPE investors and the new public investors are also able to enter in at a good valuation, such that they are going to be able to benefit from that. Because you really do want, we have a value in the company, together we win, but it's really about all constituents of the company. You want to win, and that includes those new shareholders and investors that are coming on board, because if the stock performs and continues to perform, they're going to be long-term shareholders of the company, and be core partners of the company. And so that's one thing that I would note.
Yeah, I don't know if you have a similar belief to this, but I think I also, I mean, SPACs, it goes without saying, SPACs are here to stay. They've actually been around for decades. I don't exactly know how long, but they've been around forever. And then, the volume of SPACs, I think, is the thing that's in question. And I think what you just said hits it on the head. I mean, the thing that I think is, if you think back, more than a decade ago, the opportunity for the public markets, or I guess I should say, when a company wanted to raise a couple $100 million, really they had to go to the public markets. That's how, and because the companies were at that stage, there was so much value that the public markets could still, accrete because of the stage of the company and where it was at. And, with the influx of so much liquidity and so much capital that has come in the last decade, there's been so many pre-IPO investors and growth venture investors that helped kind of fill some of that gap. It's not a $200-300 million raise. People were going to the IPO because they wanted 500 million or more. And so I think the SPAC opportunity brings back an opportunity for the public markets to come into a company at an earlier stage and actually gain a lot of value and a lot of growth that company still has ahead of it. And I think that's the big benefit of this, kind of new craze or new trend. I think
I think both for the investors to be able to get into these companies earlier, and I think for companies, us getting into the public markets earlier, is great for our company. Like we are already a better company, from things we were able to do as a public company that we weren't going to be able to do as a private company, and it increases our likelihood of building something really big.
Yeah. I think there's a lot of really great benefits all around for every constituent. I do think the big risk is that, kind of what you said before, there's maybe almost too many SPACs out there, and the risk is they start taking companies public that really shouldn't go public. Maybe it's too early, or they're just not ready, or maybe they're never going to be a really great company. And so how do we as investors or entrepreneurs kind of assess that risk and make sure like this really is the right path at this time, and I shouldn't wait a little bit longer? And I really think critically about that decision.
Yeah, I mean, at the end of the day, it typically can and it should come down to the entrepreneur, and it's just a choice. And the thing I'm trying to just counsel is to make sure it's a conscious choice, right? So that people go in eyes open, in terms of the thoughtfulness. No one is going to know the business better than the entrepreneur. And if you believe it's ready and you believe you can do it, then go for it. Do it. And if you don't, in your heart of hearts, then just wait and just keep raise some private financing and continue to work the model, and then enter the public markets a year or two later. The SPAC thing is not going away, so it's not like it's a one-time binary choice, to do it now or never. And so there clearly is going to be opportunity, and you can take that time in the private markets to get the company in a spot where it's ready to go.
All right, and one more kind of thing on that. I mean, we're using a specific word, which is entrepreneur, but that doesn't necessarily mean it's the same person who's a CEO right now, nor does it mean that entrepreneur should be the same person who should be the CEO to take the company public. So in your case, you've had public company experience under your belt, and you've had multiple companies under your belt, and you've been through the war rooms, and you've been through also the positive and the negative on it. And so you know, even when we were talking about getting ready for this, you know, going through kind of the practice earnings calls and, you know, things like this, all those things that you do before you go public, this stuff that you had experience in. You know, what do you think about, you know, how should, and I'm going to say very specifically, entrepreneurs, founders, how should they decide if they're the ones, or if they should bring in a more seasoned CEO to actually go through the process? Is there a case when that should happen?
Yeah, that's a good question. That's a hard question. I think some of it is just what also people want to do with their lives, because some people don't want to do that. Some people are really great at getting, you know, finding that problem, building it, you know, getting it off the ground, you know, inventing really, and don't want to, you know, go be a public CEO, and it's not for everybody.
Yeah.
So I certainly understand that. And so one, I think, is just that's choice, just internalizing that that's not wrong. It's just you know what people what people want to do at the end of the day. I do think that you see this right now. Just because you're a great inventor or early entrepreneur, it's not natural. There's tons of those people though that have been great public CEOs, right? So you can hire the skill sets around you, and so you don't need to be shy or scared of it, you know. And if it's your company and you want to go do it, like you can get a great, you know, investor relations person that manages all those, you know, conversations. And people are going to want to talk to you, but they can take care of a lot, you know, of that. You can get, you know, great CFO who takes care of a lot of those responsibilities. So there's all kinds of different profiles, shape and forms. But I think it's the entrepreneur deciding, you know, what they want to do, you know, with their life. And I think hopefully they have good mentors, you know, around them, and just a good community around them, so they can be able to have really authentic conversations around, you know, what would it like if they were to hire somebody else, and is that the right thing for the business? And obviously, and there's lots of cases where bringing in an outside CEO has been incredible, you know, for the business. And so it's not a one size fits all answer.
Yeah, fair enough. All right, I'm going to close with talk about your, you know, what does the future look like for you and for Porch?
You know what? I'm having a lot of fun as a public CEO. I know some people talk about it like, you know, it's going to be a negative thing. It's fun. I mean, the team, the Porch Group team is an exceptional group of people, and I feel just fortunate to be able to get to lead them and work with them. But they're in a really good spot. You know, we feel like we've just entered kind of the second chapter, you know, of the journey of our company, and it just feels like we're getting started. And so it's a pretty fun feeling when you have, you know, resources, capital, momentum, and just this huge opportunity, you know, ahead. We are excited about how our strategy is both very differentiated, and how it creates these really deep competitive moats that's just hard for people to replicate or copy. And so, you know, that just gives us the space to be able to make good decisions, make aggressive choices and bets as we go. So yeah, no, it's fun. It's you know, for people that are listening, you know, you can keep an eye on us again, PRCH, and you know, we'll be talking quarterly and updating on how we go.
Yeah, well, I'll echo that. I mean, our original investment thesis was, you know, you guys are doing something really hard. We saw a graveyard of companies before you try to do the same thing. And you guys had not only been able to achieve, you know, scale, which is incredibly hard to do in this model, but then, you know, we pushed forward with these B2B channels and partnerships and you know, ancillary services all around not only renovation and home services, but the move. And, you know, you guys have just done such a phenomenal job. So good job.
Thank you.
Thank you. And, you know, really appreciate you taking the time to share your story.
No, it's my pleasure. It's good to see you.
All right. Thanks to everyone who tuned in today. And you know, if you want to hear this again, this will be posted up on our website under our media section in the Modern Ventures Speaker Series. And we look forward to seeing you again soon.